Hi, this is Mike Maloney, and I have Ronnie Stoeferle with me from Incrementum. So, Ronnie, how are you doing?
Very good. How are you,
Okay,
Mike?
I'm doing well. What I want to do here is just dive right into the report. We finished about halfway through just section one of the report in the last video, and it was actually running long. This report has so much information in it for people. They really should download it and read it. We'll move on to the next chart, and this is sort of the environment for gold, positive or negative real interest rates. For the audience, anybody that doesn't know what a real interest rate is, it's the amount of interest you're getting paid. Do they use the 10-year Treasury for this, Ronnie?
For this year, I think we chose the Fed funds rate.
Oh, the Fed funds rate. Okay.
Yes.
So it's the Fed funds rate minus inflation. And one of the things is, we'll get to some other inflation charts later, but one of the things that people don't realize is that the inflation statistic published by the government is, it's called the CPI, the Consumer Price Index. I call it the CP because it doesn't include some necessary things like housing and energy. Inflation, what I look at, one of the things that got cut from my first book is I came up with my own measurement of inflation, and that's currency units per person. I called it CUP inflation instead of CPI, CUPP, currency units per person. And that has gone crazy. And every unit of currency has to go somewhere. That was what the theory was based on for CUP inflation, is that every unit of currency must go somewhere. What we see lately is that it all goes into the stock markets and into bonds, causing part of the everything bubble, like you were talking about. But you've got the blue areas shaded on the chart and the gold area in the middle. And this sort of gold background area is where we had positive real rates. So the rate that you were getting paid for your loaning the government currency was greater than the inflation. So you were actually getting ahead. And when you get into negative rates, the blue shaded areas, you can see that it sort of seesaws up and down above the 0% line. So there are areas where when you loan even if you're being promised a 2% interest, the rate of inflation might be 3 or 4%. And so you're actually going backwards. And gold performs spectacularly well during these periods of time. And so that's one of the things about this chart that I wanted to point out to everybody. Do you have anything you want to say on that?
No, that's just, I think, for the long-term case for gold, I think due to the whole debt situation and the stage of the system that we just cannot afford significantly higher positive real rates. So in the 80s and 90s, opportunity costs were high because real rates were mostly positive. So it didn't make too much sense to be extremely overweight gold. 70s with the stagflation was a tremendous decade. And since the year 2003, basically 2002, we are having most of the time negative real rates as well. And from my point of view, that's also something that we analyzed at length, is the direction of real rates and the trend of real rates is very, very important for the gold price. So if you see falling real rates, that's the best environment for gold that you can have.
Yeah. Falling, or even when they're seesawing up and down like this, and there's tremendous uncertainty about the future, because that's what this seesawing up and down that we've been in. We saw that during both of the gold bull markets. And I'm sure that you believe, just as I do, that we've only had a pause in what is a giant secular bull market. We've had this cyclical bear market inside of this secular bull market. That's what you believe, isn't it?
Yes. I think the correction took longer than we expected, but the market is a maximizer of pain, as a trader friend of mine once said. So we reached maximum pain basically in 2015, beginning of 2016. And it was a healthy correction, but it hurt.
The longer it lasts, though, the more energy it stores and the higher it goes. And so, I have been very grateful for this. I know my listeners hate to hear this, that I'm grateful for this pullback, but it has allowed me to accumulate so much more precious metals. I'm going to skip down to page 15 here, because the Fed actually, they've got some predictors in their database of recessions, but they actually never say that there's a recession coming. The Fed never says there's a recession right around the corner, get ready for it. What they say is, oh, there was a recession and it started a year ago. And that's what this chart says on page 15. Explain this a little bit, would you?
Well, the thing is, in our last In Gold report, we analyzed 4 different stages of every recession, and then how gold performs, how bonds perform, and how equities perform. And normally, as soon as everybody says, okay, recession is here, then the worst is already over. So markets, and especially the gold market and equities, tend to discount recessions pretty accurately. And from my point of view, in a recession, there's very few asset classes that really perform well. Gold is one of the best assets and the best currency, basically, in a recession. The question is why? Gold discounts that in the course of a recession, there's fiscal stimulus and there's monetary stimulus. So we can expect that both of those stimuli will be announced, that they will be significantly higher than in the previous recession. And I think this is what gold perhaps already is kind of sniffing out and discounting. So we might really be already in a recession or in a pre-recession, but it's pretty obvious, with the yield curve, with the earnings recession that we're seeing, with the ISM indices and so on, that we're on the verge of a recession.
Yeah. And speaking of that, I want to skip down to page 17, and that's the Industrial Production Index. Can you just explain a little bit about what the Industrial Production Index is and why it's so important in predicting recessions, and where what it's indicating right now?
Well, it's basically one of my most favorite gauges for, manufacturing, for, let's say, real production, for the manufacturing businesses, for the mining, for utilities, and so on. I mean, we all know that the US economy is very much of a service economy, but from my point of view, the manufacturing sector is a much better indicator for the economic well-being of the US. And except for the decline in 2015, which did not lead to a recession, relatively strong decline always ended up in the recession. And now we're seeing a very strong move down. On the year-on-year rate is almost negative. And that basically confirms our view. And I think this also shows why Donald Trump is so desperate and so dedicated, to get lower interest rates, to talk the US dollar down, to start trade wars, because he is probably concerned about the state of the US economy. And we all know that if there's going to be a recession in the US, he will have a hard time to be reelected.
Yeah, so I want to go to page 19, where you've got sort of a synopsis, of what can they do. You've got QE4, negative rates, currency wars, forward guidance, QE for the people. So can you run through these a little bit and touch on each one of these and give us your perspective on it?
Yeah, of course. I mean, we have seen recently that actually the balance sheet of the Federal Reserve rose, I think, by more than 200 billion. Of course, that's not QE as they said quite often. But let's face it. I mean, if things were good, and we wouldn't be seeing that the Fed compelled to come in and buy 60 billion of T-bills per month just to keep calm in the money market, and then to claim over that this isn't QE all over again. So
QE is creating currency. If the balance sheet goes up, that just means that they have created currency. They created dollars, and they bought something with dollars which is basically counterfeiting. You create a dollar and you buy something with it, and that's what they did. And that means that they're easing up on the quantity of the currency that is available, and that's QE. So they have started QE4. It might be in what they call fits and starts, where it's on and off for a little while if things go well. But this is also an indicator that they are worried about a recession, I believe.
Absolutely. And if they would have called it QE right away, I think this would have triggered a loss of confidence in the US dollar and in the Federal Reserve. But of course, it is some sort of QE, and we all know the falling marginal utility. So the QE got bigger and bigger every time to see some effect. And I've got no doubt that in the next crisis, whenever it's gonna really start going, the Federal Reserve will have to be very aggressive. The next thing would be zero or negative interest rates. I think it's pretty obvious that it is not just, a small phase where they're lowering rates. It is obvious that we have made this monetary U-turn. I mean, it might be a coincidence, but at the moment there are so many academic papers coming out also from the Federal Reserve, for example, Federal Reserve San Francisco, saying that negative rates would be a really good solution and it would have mainly positive effects. So they're basically preparing the markets again for lowering rates very aggressively.
Yeah, the fact that they're discussing negative interest rates, the first thing that you've got in that little section under 0/negative interest rates is flawed models. And it shows that their whole model is flawed if they're even discussing negative interest rates, because they're supposed to be impossible, according to real economics. But these are crazy Keynesians leading us down a very, very dangerous path. I don't know if it was in my book, Guide to Investing in Gold and Silver, that I put it, but somewhere I wrote that the Keynesians have led us into a minefield that is getting more and more dense with mines. And they've just been very, very lucky that nobody has stepped on one yet. But now we're just surrounded. And it's like, any step we go in any direction, something's going to blow up someday. So let's skip down to currency wars. Tell us about that.
Yeah, I mean, cheapening the US dollar could provide for some ease, and it would actually be also for emerging markets and the whole world economy. A weak dollar would be something positive. We remember President Nixon in 1971 saying, the evil money speculators, basically the reason why they temporarily stopped the gold convertibility, and that it will have no effect on the US dollar. We all know that it was a highly inflationary episode, that it was actually stagflationary. So nowadays the problem is that everybody wants to have a weak currency. It's not only Mr. Trump, it's also everybody in the Eurozone. It's the Chinese, obviously, it's the Brits, it's the Canadians, and it's also the Japanese. So if everybody wants to create some artificial growth by importing inflation and by lowering the exchange rate of their currency, it is pretty obvious that gold has to be the main beneficiary, right? Because gold doesn't participate in those currency wars.
Yeah, all of the fiat currencies are in a race to the bottom compared to gold. This is the way it's always been, though, is fiat currencies eventually go to zero compared to gold. So forward guidance. Now, this is just the Fed jawboning the markets, right? The Fed just making statements, and the economy, the markets react to whatever Jerome Powell says. And that's sort of crazy, because companies have a certain value to them. And whenever the Fed opens its mouth, the perceived value, I mean, the buildings didn't change, the production facilities didn't change, the number of employees didn't change, but suddenly the value of the stock changed. So tell us about forward guidance on monetary policy.
Well, that's basically that the Federal Reserve would reassure everybody that they will act accordingly, and that they will stimulate and they will step in if there's something happening. And I mean, the sheer fact, Mike, that nowadays it seems that it's only about anticipating what the Federal Reserve will say and do next, and that there's an army of analysts basically just analyzing and trying to forecast what central bankers will say and do next. This already shows you how addicted we are to monetary stimulus. If you talk to people, that were in markets like 30 or 40 years ago, they say, okay, we didn't have a clue who's sitting in the Federal Reserve actually, and what they would do, because
Right. I mean, back in the 80s, 70s, 80s, 90s, nobody talked about the Federal Reserve. That just wasn't even on the news. They made statements, but they just weren't like the media shouts them out through this, loudspeaker, this PA system, public address system. They shout them out to the entire world, and the markets react. Nobody reacted to the Federal Reserve back in the 70s, 80s, and even into the early 90s. And now, you're right, we are addicted to it.
Yeah, so I mean, back in the days, we talked about balance sheets, but not about the central bank balance sheet, but a balance sheet health of companies. We talked about business models, about valuations of companies, but this is over, unfortunately, and that's just not a healthy sign. And this shows how flawed our capital structure is nowadays.
Okay, and the last topic on this page is the scariest one, QE for the people, and then the famous term helicopter money. And I believe that came from Milton Friedman, talking about like the last ditch effort you can do to try and stimulate inflation is drop money from helicopters. Well, I don't call it money, first of all. I always call it currency, because it's a fiat currency. Throughout the centuries, only two things have proven to be money: gold and silver, because money has to be a store of value. That's one of the attributes. Currency is a medium of exchange, a unit of account. It's portable, durable, divisible, and fungible, which means all the units are interchangeable. If you loan me a $20 bill, I can pay you back a 10, a 5, and 5 ones, and you don't care. That's fungibility. And then money has to be a store of value. So it's all the things that currency is, plus it's a store of value. There's a chart in this section that's a perfect illustration of that we'll get to later. So it would be helicopter currency. And I believe it was my episode 6 of Hidden Secrets of Money, where I show basically this theory. But tell us about QE for the people and how dangerous this is, and how much, I mean, right now, there's a lot of politicians talking about it. And this is pretty scary.
I mean, yeah, the thing that nowadays analysts, central bankers, the media is really very often talking about the introduction of helicopter money and MMT, modern monetary theory, or as a friend of mine once called it, the Mugabe-Maduro theory of money. I think this already shows how crazy it got, and just from the Financial Times, for example, that Mario Draghi will leave his office very soon, and that Mrs. Lagarde will step in, and they wrote in the FT, Mrs. Lagarde will oversee a strategic review. This would have the scope to examine even more radical ideas, including the possibility of changing its inflation target, and even the idea of the central bank paying money directly into individuals' bank accounts. So, I mean, this isn't a concept and a wet dream of some economists. It is really going to happen. And I don't know about the exact term and definition, if it's going to be MMT or QE for the people or helicopter money or whatever, but it is happening, and it will have much more direct effects on economic growth, but especially on inflation, much more direct than quantitative easing.
Yeah, one of the things that people don't understand is that when a central bank creates currency, the way it goes into circulation is they have to buy something, and they usually buy a debt instrument. It's usually something like a treasury bill. Now, if they are putting currency directly into people's bank accounts, if they're handing it out to the people, the way that would work in the United States, the Federal Reserve would create currency and buy U.S. treasuries directly from the Treasury, and then the government would deposit that currency into somebody's bank account. But we all owe it back through taxes because they're buying US treasuries with this currency that they created. It's highly immoral for them to be perpetrating this fraud on the public, and the public doesn't even see it. But whenever they create currency and whenever they create stimulus, it's all owed back plus interest.
Yeah, I mean, if you would explain that to a kid, you would probably say that's impossible. That cannot be accepted and it cannot be done. But it is, yeah, it is like it is. And unfortunately, it is not being taught in school or on universities. And that's probably for a good reason.
Yeah. I want to wrap up this segment right now. I also want to tell our viewers that it's really time to get ready for something big. It's time to prepare. I don't like to use the word prepare because it pegs me as a prepper, and I'm not really a prepper. But then again, I sort of am. I'm a monetary prepper. There is something big coming. Don't you agree, Ronnie?
Yeah, absolutely. We know that central bankers are pretty desperate. Normally, in the course of a recession, they lower interest rates by 5 percentage points, so 500 basis points. Then we would be deep in negative territory, even in the US. So I think, it's going to be interesting.
To me, negative interest rates are a signal that there's still an emergency going on, because there shouldn't be anything such thing as negative interest rates. It's absolutely crazy. But I want to wrap this up. I want to say thank you very much for being here for this interview, Ronnie. Go to his website, download the report, but make sure that you subscribe to our channel and click that little notification bell so that when the next video comes out, you'll be notified. We'll see you next time. At goldsilver.com, we have a price match guarantee, free shipping, and global storage options. Learn more about how to invest in precious metals at goldsilver.com.